You go and buy what you want. We'll measure you from a performance standpoint against MSCI, but you're back. You're cool. Brackets. If you screw up, we can sack you on 6 months' notice. Close brackets. That's 80% of the buildings that are going to exist in 2050 are here now. So somebody else can worry about the 20%, building those. We're focused on the 80%, buying second-hand, trying to improve them. If you're going to use the word impact, it's got to mean something. You can't just greenwash something else and say that's now impact, because that doesn't work. So you've got to work quite hard with measurement structures, scoring systems, setting targets. We've pivoted the business away from running, not completely away, but away from running core balanced mandates towards running strategies more aimed at decarbonisation or, if not, full impact. Doors open for you, you step through, and you go on a learning curve, don't you? And you learn or you fall off.
Philip, welcome to the podcast.
Thank you. Very nice to be here.
Not at all. Well, look, you've had a really interesting background, and I'm very keen to unpick a little bit about your journey, your experience, and then obviously spend a little bit of time on Orchard Street Investment Management and how you see the market and where you see the opportunity. But before we get into some of that good stuff, can you tell me about how and why you got into real estate in the first place?
Blimey, how I got into real estate. Good Lord. Well, you've got to go all the way back to the 1970s, because that's when I was at school. Well, the 1970s it was all about what are you going to do when you come out the other end? Hey, are you going to get a job? What are you going to do? And I ended up thinking I was going to go into property. I wanted to do something with property. Why did I do property? Because in a very simplistic way, I fancied not having a desk job, wanted to get outside of it. And somebody had said, they didn't say real estate in those days, they said property. Doing property might get you to that sort of place. So I thought, all right then. So I went to Reading. First person in my family had been to uni. So that was a bit of a trailblazer. Went to Reading, came out the other end of that. And then the usual sort of interview process at the end, because there wasn't much of a plan. It was get a job. Because you haven't got a job, what are you going to do then?
And this is I'm aging you slightly, but pre-internet, pre-everything. So it's not like you could go online and kind of see what everyone else is doing and get all the career advice.
At uni, there were notices that would come up on the boards, and the Jones Lang team they're coming down for interviews on that day or something, and I forget quite how it happened. Now, you get yourself on a list. Maybe you wrote an application in or something, got yourself on a list, had a bit of an interview. And then if you got through that interview, then I came up to London for an afternoon, two interviews in an afternoon or something, was it? And then happened to get that job. Benefit of hindsight, looking back, being offered a job at Jones Lang Wootton, as it was then, I think that was the one to have.
What kind of kid were you growing up?
Fairly normal. I think I've got an older brother, and my parents were non-working mum, which was not unusual then. Dad was a bank manager. They scrimped and saved to send me and my brother to a private school, which was, we didn't go on foreign holidays, therefore. Wasn't particularly, I don't look back of myself as thinking I was reasonably academic, but the grades I got were quite good, so it meant I could go to Reading and all that sort of stuff. But it was a perfectly normal, happy kind of upbringing in sort of south of London, down there somewhere.
Did you have friends or family in property or real estate?
No.
It's interesting because real estate, or I keep calling it real estate, has got kind of a bit of a connotation of being a bit of an old boys club, and it's only people who've got connections to real estate. Yep. And I've done over 130 of these conversations now, and I'm going to say probably 15% of people have got a parent or a godfather or an uncle or an auntie in real estate. So it kind of flies in the face of all the stats that kind of get bandied around. So you landed at Reading, did the real estate course, went to Jones Lang Wootton. Did you rotate and get your APC? Or
I did get my APC. Did I rotate? Oh, I didn't really rotate. I managed to not rotate. Started off in property management because that was the first place you went, and I thought this was awful. Don't want to spend long in here. And I managed to get out of it. This was in the city, so Jones Lang had a big office in the city and in the West End. But they wanted to be on the 5th floor at Kent House in Telegraph Street in the city. The 5th floor was where all the main partners were. It's where the investment stuff took place. You wanted to be there. And I managed to find a slot working for one of the really old senior partners on the 5th floor after about 9 or 10 months. So I got up there. And then that coincided with a now retired, I think, reasonably senior partner, but young and upcoming partner at Jones Lang, a fellow called John Stephen, who'd just come back from a stint abroad where he'd been in Asia, Hong Kong, Japan as well, I think. He came back and needed some young oik to help him do stuff. So I managed to get grabbed by him. And then not long after that, a fellow called Chris Bartram joined the business in 1985, I think. And Chris had been he led what was then called Scottish Amicable from a property perspective, ran the property business there. And he joined Jones Lang. I don't quite know what his job brief was, but it might have been, the world is heading towards fund management. You guys at JLW need to spec yourself up. I'm happy to come and help you do it. That might have been the speech. Anyway, he joined in 85. And I was the young guy looking around doing a bit of work for John, and he grabbed me a bit too. And then there was a famous decision point. I can't remember when it was now, but they both wanted me to come and work for them more. And I sort of said, well, I've no idea how to make a decision about that. But anyway, Chris won that battle. So I ended up, I've no idea how that worked out. But anyway, I ended up working more for Chris, which then led me in about 1988-9 time to, funnily enough, gravitate from, well, I was still definitely Jones Lang Wootton, but gravitated to something that had then been set up reasonably recently called JLW Finance, which is a sort of corporate finance part of Jones Lang. Because Chris had won a relationship with the Alliance and Leicester Building Society to do what we might call now a fund management role, but credit, not equity. And he'd won a mandate for, I don't know, 100 million or something like that, which was not small in those days, to lend money on development projects. So we ended up with this reasonably niche product where we would lend developers 100% of the money so they could do commercial developments, and we'd take a profit share. We'd take an interest rate arrangement fee, but a profit share. And it was all IRR driven. Well, back in 1988-89, that was all quite trailblazing, and guys cleverer than me had written themselves a program which could calculate IRRs and all this sort of stuff. I was fortunate that I knew what IRRs were because I did all that at Reading. I was also fortunate that in those days, if you walk around with something called a Hewlett-Packard 12C, I think it was called, you were a tall dwarf. And I knew how to work a Hewlett-Packard 12C, which was in those days, reasonably sexy calculator that did stuff. And most people just had 1 + 1 = 2. So I had one of those, knew how that worked, and I knew what I was doing in that space. And so I worked with Chris quite closely, and we lent quite a lot of money for Alliance and Leicester on a number of different projects. And with the benefit of hindsight, we were lending money in 89, 90, 91. I think we lent on 10 or 11 projects. The first 3 or 4 were really, really good. The first one, we built it, let it, sold it, and did it at Alliance and Leicester an IRR. I think the number that sticks in my mind is about 26% IRR or something. And they were a house building lender or house lender. They never had a 26% IRR return on anything. So they all thought they'd died and gone to heaven. And we carried on. And then, of course, we went into the 1991, 92 sort of time. And obviously the last few projects didn't do quite as well as that. But so I ended up spending 2 or 3 or 4 years arranging that money. And then I spent the next 2 or 3 years trying to get it back again. So I learned quite a lot of developers going bust, trying to let buildings that nobody wants to let, all that sort of stuff. That was quite educational through that period.
And did you enjoy being more on the kind of the lending kind of credit side rather than the equity and principal investment piece?
I'm not certain I saw it as fundamentally different. It was clearly it is now, but we didn't think of it. It's credit and equity. It was an arrangement with a client called Alliance and Leicester, and we were lending their money as it happens on. But at one level, it was 100% of the money we were putting in, so a piece of it was equity. And again, we didn't really think of it quite like that, but the IRR that we were after on our money probably reflected that a bit. So that was an interesting time through that period.
And did the mandates keep coming and growing and take more responsibility?
Well, from 1990 onwards was really a reasonably rich vein of fund management growth for the industry. But for Jones Lang too, and the pitch team, which Bartram led, went out and won quite a few separate account mandates at that time. We had one or two at the time, but we looked after money for people like Unilever and Mars Pension Fund. But Chris won a big mandate from the Railways Pension Scheme and various others, including one I'll perhaps come back to in a minute called Kodak Pension Scheme. And they were the Railpen one was quite a trailblazing one, because it was managing the allocation of real estate, and you could be in cash if you wanted to. And if you were in cash, you got the benefit or the burden of the cash return in your relative return. So benchmark to MSCI, like everything else was, but that had a bit of cash in it too. And if you're smart, that could be helpful. And if you were not smart, it wouldn't be. So, but they were happy on a discretionary basis to give Chris, I know it's Chris really, sort of at Jones Lang Wootton, of course, but nonetheless, Chris, that kind of responsibility.
And were they 3-5 year type funds or arrangements?
Evergreen.
It was evergreen.
You're there till you're sacked.
And Chris or Jones Lang would just invoice kind of quarterly management fees, and then get shares of promote or upside based on returns?
Didn't really have promotes in those days. It was at least I don't think there was. I don't recall there being a promote in those days, but it was management fees, primarily management fees. Yeah, I'm not even certain there was transaction fees involved. Going back to the point about separating JLW fund management from Jones Lang Wootton. Jones Lang Wootton's all about transaction fees. The fund management piece is about managing capital. Can you collect a fee for managing the capital? If you've got a transaction fee, haven't you just baked in some kind of conflict?
Yeah.
You're going to be remunerated in the wrong way. We don't want you remunerated in the wrong way. We want you remunerated in the right way.
Yeah. So we'll just pay you an ongoing fee, and then you'll have a fiduciary duty to kind of deploy that capital in line with the arrangement or the parameters that we kind of agreed.
And most of those arrangements, as they've carried on being, actually, you're sacked on 6 months' notice. No fault, or may not be a fault. If you've done something wrong, clearly they can sack you. But 6 months' notice, that's the deal. But that doesn't mean you're going to get sacked on 6 months' notice, and you can carry on running these mandates for years, which is often what happened.
How did your kind of role evolve throughout that period?
Yes, having done a little bit of time and effort and work in the finance business, Chris then left in '95, and I got gifted. I was invited to take over the Kodak pension plan at that point, which was one of the ones that Chris had won, with a mandate to invest in real estate, but agnostic with certain risk controls, but agnostic whether you invest in equity, listed equity or unlisted equity or cash. So I got this thing. Oh God, how on earth do you do this? So that was a steep learning curve. I inherited one or two, well, we call them REITs now. They weren't REITs then, they were just listed companies. Inherited a few of those that the previous guy had bought into. Walked my way around brokers in the city trying to figure out, because there were quite a few IPOs, real estate IPOs coming down the track then, trying to figure those out, and bought a couple of those at IPO, like I bought Quintain when it floated, and I also bought Big Yellow, I think, when it floated, which did quite well, but probably more luck than judgment. I mean, in theory, you looked at it as a surveyor and sort of thought, well, this still looks all right. I made a bit of money, but I didn't allocate enough to it so that when it made a bit of money, it didn't make a huge amount of difference. But meanwhile, the kind of reputational risk that you've onboarded, because if this goes wrong, it's all coming at me.
Yeah.
If it goes right, well, a small tick in the box. If it goes wrong, wallop. So I did a couple, and then I thought, maybe there's easier ways to make some money. So I did one or two other slightly more interesting deals with real estate joint venture deals and that sort of stuff, which produced slightly better returns. But again, benchmark to MSCI. So same thing, and you're just trying to get there in using other tools that you're allowed to use by the client.
Was there much kind of institutional like rigor and structure and portfolio allocation and
at their level?
Yes, at their level.
At their level, they would do the pension schemes in those days would do asset liability modelling, and consultants would turn up and help them do that. And when you were pitching for these new client relationships, you were in front of the consultants. It tended to be the consultants that would lead it. So in those days, it was Bacon and Woodrow, and that's a name I remember anyway. There were probably one or two others as well. Watson Wyatt probably. I mean, all these names have gone now. They've merged into other things. But you talk to those guys, and those guys would have a kind of top-down perspective on what the pension fund would be doing, and they'd report to the trustees, and the trustees would make the decision, and the trustees would make the decision about appointing the property manager, would they, or was it just the guy who ran the fund? I can't remember. The guy at Kodak, a fellow called Mike Stockwell, he ran the pension fund, and I guess he reported to the trustees. But I think it was his decision whether or not he was going to appoint Jones Lang to run the property piece for him.
Yeah.
But he ran the whole of the pension scheme, equities, bonds, real estate, etc. So I turned up there one day on my own. I had to go and meet Mike at Kodak. Went up there on my own, and he was interested in all sorts of things that I wasn't ready for. So I had to learn really quite quickly dealing with him, because he was nobody's fool. Anyway, over a period, we formed a nice relationship, and that was fine, and did some nice things for him, and it was all fine. But I found, doors open for you. You step through. You can hesitate if you want and not step through. I think I've generally, I can't think of a door that's open that I haven't stepped through. And you go on a learning curve, don't you? And you learn, or you fall off. You fall off the wheel, or you keep going.
Have you had kind of a grand plan in terms of your career and the trajectory?
No.
Or has it just been, as you said, opportunity driven?
Opportunities, doors have opened. Start off, the first thing, there is a grand plan, get a job. That was the grand plan.
Yeah.
Got a job, and then it's just gone on from there, really. Get a job in real estate. Yeah, those are the two things. Why real estate? I don't know, because I might not be desk-based for my entire career, which has turned out to be right. I haven't been. But there wasn't a lot more to it than that. Get a job.
Follow the opportunity, see where it goes.
Yeah.
You spent best part of 18 years at Jones Lang Wootton,
Yep.
Sal,
Yep.
fundamentally.
Yep.
You left there in 2001 and you
Yep.
set up Gatehouse Investment Management.
Yep.
Tell me about that door and that opening and how that came
That
about.
door, yeah, that door. Well, I've been in the fund management piece at Jones Lang for quite a while. Then we'd merged. Through the merger, quite a lot of Jones Lang Wootton was left untouched, but the fund management piece was materially touched because it was merged into LaSalle Investment Management. And whilst in the UK we were quite good on separate accounts, SEGI mandates, those sorts of things, we weren't really then in the fund space. And LaSalle was in the fund space, putting fund strategies together to doing particular things, going out and raising capital, et cetera, et cetera.
Yeah, just so someone listening to this, the difference between the fund management space and the separate account space?
Well, it's managing capital. It's just the nature of the contract. So we would win a mandate from an individual investor, Railpen, Kodak, what have you. They'd appoint you on a contract with a 6-month notice period. So it's a separate account. You're only managing their money with that portfolio of properties, and you're managing it until you're not. It's a sort of evergreen. In the funds business, you might still find that Railpen or Kodak or what have you are investors in your fund, but you've got a fund of a number of different investors, and the fund will be set up. They're not always closed-end finite life, but many of them are. So on LaSalle, we're setting up 6-year, 7-year life funds with investors from their network of global investors to do particular things. So when we merged with them, they'd done a European Opportunities Fund. I think they're raising capital for another European Opportunities Fund. I mean, they took us as Jones Lang from a UK-only business to being pan-European and getting into the fund space. So a big leap. They've been doing, I'm going to call it proper funds management, if you like, rather than the version that we were doing. We're making pretty nice money in it, but it was separate accounts only and single country, really. They were doing something a bit different to that, a bit further on, several leagues further on up that growth journey. And so we were chucked into that as part of the merger, and I spent a year or two in that space and began to think that I wasn't enjoying it quite as much as I was.
Because?
Small cog in big wheel. And now talking about global, no experience global. Funds, not really any experience in funds. Little bit, by the way, I might touch on that in a moment. Little bit of experience, but not really at the level that LaSalle were doing it.
In terms of just raising these big commingled
Yeah.
funds
And
from a global capital base.
They had a team of capital raising people, based in a global team of capital raising people based in Chicago, a couple of people in London, or was it three? Somebody in Asia, 2 or 3 people in Asia, somebody in the Middle East. We didn't have that. We were miles away from having that. So they took us to a new place, which was great. Our funds experience then had been, funnily enough, probably not everything that I'd been doing, because we had done one or two other funds things within Jones Lang Wootton, but we set up, when I had 1 foot in fund management, 1 foot still in the finance business. So we set up a leisure fund in 1996 or so, was it? There used to be a property company called Marylebone Warwick Balfour. I don't know if you remember them, MWB. I think they've gone bust now. They have gone bust. Don't know where they went. And they felt that there was an opportunity to buy leisure property, and so we did. We set up a fund for them, where we raised 50 million quid or something, which was trailblazing. Well, at least for us it was. I think others were doing it to probably to a much greater extent than we were, but for us, trailblazing, to buy leisure property in the UK. Cinemas and restaurants and that sort of stuff. And the first thing about that was, well, what's the legal structure? And so you go and talk to an investor about, I want to do this leisure fund. Oh yeah, great, marvellous, like all that. What am I investing in? Because we go and talk to property investors and try and get them to allocate to property. So they got the leisure store. Yeah, okay, get that. What am I buying there? And then, well, you're going to become a limited partner in a limited partnership. What's that? So you'd spend most of the presentation talking about legal stuff, about what the legal structure is, because people didn't do limited partnerships in those days. I mean, there's millions of them now, and everybody's an expert in how limited partnerships work. But in those days, people didn't know. So we spent a lot of time talking about that, and it needed to have an operator in it, a regulated entity needed to provide an operator role, and you had to become savvy in all of that stuff. Anyway, we did that in about 96. I tried to do a residential fund in about 96, 97 time. So we'd done some fun stuff, but we were nowhere near where LaSalle was. And I began to think that, small cog, big wheel, there's better opportunities floating around out there. And that coincided at the time with another partner I had in there called Duncan Owen. And Duncan and I decided that we were going to do our own thing. So we were going to leave, set up our own business. So after 18 years of Jones Lang Wootton, called it a day, and we set up our own business in 2001 called Gatehouse Investment Management. And there were 2 of us. We managed to recruit 3 others into that business at the time. We had a little office building right down the bottom of Arlington Street in St James's, in a little building called the Gatehouse. And we attempted to build a fund management business. We got ourselves regulated somehow. And we'd sort of hoped that that 1 or 2 clients that we'd worked on at Jones Lang would follow us. And we were, looking back, we were incredibly naive, because there wasn't a prayer that big clients were going to leave the mighty Jones Lang, now LaSalle, and come and join a little startup, even if there were 2 guys that were the same guys. They were just never going to do that. And guess what? They didn't. But we managed to find some business to do, which wasn't perhaps blue-blooded fund management business in perhaps the way we'd hoped. But we found some business to do, earned a bit of money, paid some bills. And then we had a cunning idea. That big Magna Park logistics park up the M1. We began to think, well, wouldn't it be a good idea to put all that back together again into one big park? Because it's got, 15 different owners of different bits and pieces. And Gaisley was still there, and they still owned a bit of it. And we managed to get in and talk to Gaisley, and they were quite up for trying to be part of a new fund to put the whole of Magna Park into a limited partnership, because I imagine that's what it would have been. So we started to go around talking to some of the other institutional owners of those big sheds. We've got a cunning plan. Why don't you merge your property interest into our fund, and instead of you having 100% of that unit, why don't you have 10% of the whole thing? And it was a really good idea. Immediately you bumped into conflicts, because we talked to great big fund managers, and they say, well, why would we want to give you those fees?
Yeah.
But one of the conversations we had was with what was then called Clerical Medical. And Clerical Medical had more than one, or just one big shed, I think, on Magna Park. And we had a conversation with them, and it was just at the time with Clerical Medical that they'd been bought by HBOS, had they? Is that how it had worked? HBOS owned Clerical Medical. HBOS had just bailed out Equitable Life. They owned Bank of Scotland. They just bought a Rothschild asset management business. So HBOS had just got all these businesses, all in the asset management space, and they were just at the point of merging them all together and running it as a single business. And they come up with a name, and it was called Insight. So it became Insight Asset Management. They'd recruited a chief executive called Dougie Ferrens, and he came in to run it. So we went and saw the property team at Clerical Medical, who were guys who'd been running a property portfolio within a institution called Clerical Medical. And suddenly they were being asked, right, you've got a property business here, we want you to grow it. And they were sort of going, well, how on earth are we going to go and do that? So us two likely lads walked in there one day and said, well, we've got a good idea. Why don't you put that property into our fund and we'll run it? And a few days later, or a week or so later, there's a famous letter that I've still got somewhere on a file that Charles Hunter, who was running Clerical Medical at the time, he wrote to us and said, thanks for coming in, blah, blah, blah. And it sort of said at the end, but by the way, if you ever fancy giving up your hard-won independence, perhaps there's a different conversation to be had. So we sort of spotted the hook and nibbled on it gently, and that turned into us being bought out by Insight. They bought the Gatehouse business, and the 5 of us in it, or was it 6 by then? Might have been 5. One had gone and one new one come in. So we went into Insight and sort of reversed ourselves into Insight to take over the business, take over the operating unit within Insight. And Duncan and I had a conversation about who was going to run it, because they wanted one of us to run it, not the other. And I said to Duncan, you go and you run it. I want to go and do these things, do some business. You go run it. So he did, and managed to get a quite an aggressive business plan approved by the board. Because when we got there, it was, I think we had 3.5 billion under management in total, with a little bit that we had at Gatehouse plus what Clerical already had. And I think our business plan was to take it up to 6 or 7 billion or something. But again, you then learn some other stuff. And so the other stuff in there, we were able to win the mandate from St James's Place where we got to now. That was 2003 we got to Insight. We won the mandate from St James's Place in 2004, and that gave them the opportunity to start their new property fund, which they did in 2005. So we then had the St James's Place capital raising machine raising capital for their property fund, which then became 2 property funds not long after. We had Clerical Medical raising money for their property funds, a little bit from Bank of Scotland. Oh, and the other brand, of course, brand's not quite the right word, is it? Within the HBOS group was Halifax. And Halifax had property funds too, and so they were raising money. So suddenly, as they used to describe these pipes, you turn these pipes on. They take a while to turn on, but once they're turned on, capital was just flooding at us. And I can't remember the numbers now that we used to try and deploy, but we grew from three or so billion in 2003 to about 10.
Wow.
Somewhere around about the GFC time. Can't quite remember when the high water mark was hit, but somewhere around about the GFC time. Open-ended property funds, so St James's Place, Clerical Medical, those sorts of funds. And also, when we were at Gatehouse, we began to learn a little bit about capital markets. And we worked with a group then to do a new investment trust. We launched an investment trust with them. So learned then all about IPOs and writing prospectuses and pitches and board meetings, all this sort of stuff, Guernsey-based things. So we're then getting on aeroplanes, going out to Guernsey, do all this stuff. You're learning, keep learning, just never leave the office at the end of the day without having learned something. So I learned all that stuff. And then when we got to Invista, we did our own, or Insight, we did our own investment trust, which Cazenove launched for us. And then we had access to the capital markets as well. And then not long into that program, not only did we do a rights issue on that, but we then did a debt securitization on something as well. So we were doing all of this stuff, and capital was flooding in, and hence 3 billion grew to 10. And somehow through all of that, We managed to keep our performance relative to MSCI ticking along quite nicely. We won Property Manager of the Year or something in about 2006 or something. We did a couple of new closed-end fund programs, one in Asia and one other. We were doing some really quite exciting things. I think others would be better placed to comment, but I think we were, if you wanted to go somewhere to get a job in the real estate market, or the fund management end of the real estate market in the 2004, 5, 6, 7 time, Insight going on in Vista was the place to be. But anyway, in 2005, 6, we began to think that being our own business with our own balance sheet, because co-investment was something that would become important, we could do with being our own little standalone business, not branded Insight and not being seen to be part of Insight. So we managed to agree with the board to allow us to IPO the real estate business out of Insight, and we did, and we sold 45% of it in the capital markets, and HBOS retained 55, so they kept a majority. That was in 2006.
Timing was good.
Timing was good. It didn't fly off the shelf, but it flew enough to get it away, which was good. And then 2 years later, GFC hit. So
it went from challenge around raising capital, taps turned on, deploying capital, deploying it aggressively, and then GFC hitting, and then trying to protect the capital and protect your positions as best you possibly can.
Then you go into reverse. St James's Place had redemptions. So now you're trying to sell properties, sell them in a hurry, sell them not as a forced seller, yo-ho. And so that was difficult too. Clerical Medical, same thing. They wanted their money back, or their investors wanted their money back. And a lot of these retail type investors, because ultimately SJP their investors are probably a little bit higher end, but it's still retail money, one end of the retail money spectrum. They're informed to some extent, but not really. So they'll read their newspaper one morning and it will say real estate terrible, and they'll think, oh, I own some of that, I better go and sell it. And SJP, we discovered later on, some years later, SJP has a firewall in the decision-making process, because you can't log on to an SJP portal, log into your account, find your real estate piece and hit sell. You can't do that. You have to make a phone call. You have to talk to somebody, talk to your partner, and your partner will say, well, hang on a minute, we're in this for the long term. This is just short-term noise. Don't worry about it. It'll all be fine. You don't want to sell today. You really don't, for these reasons. And investor would say, actually, you're probably right, I don't. And they wouldn't sell. But a lot of the other open-ended real estate managers didn't have that firewall. And so the big names running programs, probably through the GFC, and more recently too, when we've had open-ended fund outflows over the last 5 or 6 years, some of the bigger fund managers, you just can't stop the money going out unless you suspend.
Which happened a fair bit.
Which happened, yeah. So that was GFC. We learned a lot through that period. Of course, HBOS, 55% owner of Invista, went bust. 5th largest bank in the UK, was it? Was it the 4th largest at that point? Banks don't go bust. I wasn't part of the underwrite. And the other thing, when we floated, we managed to get ourselves, Duncan managed to get, he had a relationship with Alistair Ross-Gooby. I don't know if you remember that name. Really well-known, well-regarded fund management leader and thinker. Had run Hermes for a while and so on. And everybody knew he was ill. He knew he was ill. We'd even put a special risk factor in the prospectus that Alistair Ross-Gooby, chairman, has a long-term health condition. Anyway, within a year he died, bless him, which was really sad. But it sort of knocked the stuffing out of Invista from a governance perspective. And Alistair was all over governance, and things were done. Things were done properly. I'm not saying they were done improperly afterwards, but there was a way of doing things with Alistair, and he was all over process and made certain he got it right. And when he died, we just lost something a little bit. And then capital was leaking out. HBOS had been bought by Lloyds. They rescued, that's a better word. Gordon Brown told them to go and buy HBOS, so they did. Probably paid too much for it. I think there's a court case still running on that, isn't there? And Lloyds, it turned out that Lloyds owned something called Scottish Widows. Scottish Widows owned something called SWIP, which is Scottish Widows Investment Partnership, and guess what? That had a real estate fund management business in it. And it wasn't long before Lloyd said, hang on a minute, we've got 100% of this business over here called Scottish Widows, and we've got 55% of this business over here called Invista. And Invista's running a lot of our money for Clerical Medical and Halifax and stuff. Well, why don't we just put that in here, and then we get the 45% we don't own? So they did. They served notice on us. And that was the end of Invista, frankly. One or two other bits of noise going on at the time, which we don't need to go into, but that was the end of Invista, and the relic of Invista was bought I think it had one client mandate left in it and a little bit of cash, and that was bought by Palmer Capital in 2012, I think 2011, 2012. Really quite a good deal for them. Made a few bob out of that. I think Townsend put some money into that proposition that they come up with. They bought Invista. So I was let out. I was let out I think it was 2012. I was let out from Invista, having managed this thing downwards, letting people go and all that sort of horrible stuff. But that included St James's Place deciding that they didn't want their money managed by Invista anymore. So they did a beauty parade, and completely coincidentally, but Orchard Street won the beauty parade. Orchard Street being the business that my old chum Chris Bartram had set up in 2004. And so he won that mandate, and that led to an interesting dialogue that we had under the broad heading of 2P, because there were people within Invista that were in scope for 2P. Yep. And so I think I did the right thing here. I managed to get 6 people, I think it was 6, across from Invista that was by then going nowhere to Orchard Street. And in fact, two of them, no, one of them now. One of them is still there. Was 3 until quite recently. So I watched St James's Place go to Orchard Street, thinking, that's quite interesting. Good for Chris, I thought. Nice little business at Orchard Street. Well done. And I then sort of went off in 2012 thinking, what should I do now? Had a couple of phone calls to do a bit of consulting for a couple of people, which not certain that was quite my bag. One of them was, funnily enough, was at Palmer Capital, helping Alex. He said, can you come and help me for a bit? Because I bought this thing called Invista. Alex Price. Yeah. So I helped him for a few months doing that. And then I got a call effectively from Chris at Orchard Street to say, we're having a bit of think about what we want to do, and we wondered whether you might want to come and help us, which turned out to be code for, I didn't realise it quite at the time, but code for I want to retire and we need somebody to run the business. So that turned into me joining Orchard Street in May 13.
May 13, and then I think it was National Australia Bank came in 2014.
Yeah, again, when I joined, I didn't know that there was potentially a corporate discussion, and it wasn't particularly advanced, but it had gone past first base perhaps, but it was plenty of scope for it to fall over. But I was agnostic whether they did it or not. I'd probably rather they hadn't, because I quite fancied running this business that we owned all of it rather than having a big corporate shareholder. Anyway, they decided that was the right deal for the business, and that was fine. And so National Australia Bank came on board in 2014, October 14 was it? And Orchard Street has, having got St James's Place on board, looking after then another interesting little journey for the Railpen. Remember I mentioned Railpen from years ago that Chris had won at Jones Lang. Well, when he left Jones Lang in 95, Railpen looked up and said, well, we quite like being advised by you. Can you stay on it? So he managed to persuade Jones Lang to let him stay as a sort of consultant or advisor or something like that. Jones Lang still running the mandate, Chris sort of advisor. Yeah. That sort of survived the merger with LaSalle for a bit. And then I think Chris think Chris would say that he got a phone call one day from Railpen and said, actually, we don't really like this arrangement anymore. Can't you just set up a business and do the whole thing? And so they helped him start Orchard Street in 2004. So come me turning up, 2014, the Australians had turned up. We're still looking after money for Railpen. St James's Place has now been on board for 3 years, was it? And capital pouring in. So we had all that to deploy, money for Railpen to deploy. We'd won, before I got there, they'd won a mandate from the BBC as well, so running a piece of money for them. We'd won another one from GE, another one from Middle Eastern Group. So there's a little bit of an echo of Jones Lang in the early 90s winning separate accounts. They're all separate accounts. And that was where we got to. And then what was it? When was it? May, June 16 was the referendum, wasn't it? And then nothing like the GFC, was it? But then everybody sort of paused a little bit at the referendum, and everybody thought some of these open-ended real estate funds, there was a few outflows. SJP hardly anything, testament to the stickiness of their capital. But then everybody thought, referendum, yeah, okay. Oh, well, let's crack on. So everybody cracked on for a bit, for another 2 or 3 years. And then the whole coming out of Europe thing began to become quite messy, didn't it? And then COVID hit. And so a number of different things then happened. We're not in Europe, okay. We're now all working from home, okay. Need for commercial office space, particularly offices. Need for that, not quite what it was. Retailers had a really difficult time through the 16, 17, 18 period, I think it was. Retail values began to go down quite quickly. There were reasons for investors to not invest in real estate, perhaps, which perhaps hadn't been the case prior to that. And so SJP, I forget quite, they carried on growing nicely until, 2000, and maybe just before COVID hit. And then all the open-ended funds began to struggle with outflows.
Yep.
And SJP were no different. And indeed, I think it was in the beginning of COVID. So when was that? That was spring 20, wasn't it? When COVID hit, SJP, for the first time in their life, made the decision to suspend. Primarily because the valuers looked up and said, look, transactions have stopped. So we don't know what anything's worth. And the valuers came up with their market uncertainty clause, where they stuffed that in the back end of their valuations. The valuation's 100, but page 126, we've no idea what the value is. It's sort of a bit unkind, but it sort of said that. So SJP looked up and said, well, if you don't know what these assets are worth, we can't price the units. If we can't price the units, we need to suspend. So they did. And they suspended for the briefest amount of time possible. So they tried to, I think they followed best practice through this. You couldn't value the properties, you couldn't value the units. From a technical standpoint, you've got to suspend. So they did. The minute the valuers looked up and said, right, our market uncertainty clause is now gone, we don't need it anymore, SJP looked up and said, okay, in which case we know what the assets are worth, we can now price the units and we unsuspend. So they did unsuspend 6 months later. And then we've been in a period of lots of outflows, small pause, lots of outflows, small pause, lots of outflows. And that's ended up being the SJP journey as it's related to Orchard Street. But no different for other open-ended funds. And these days, how many open-ended funds in the real estate market are there left? I mean, not many.
Property is a people business, hence the name People Property Place. Business has been tough the last couple of years. Get the people aspect wrong, business becomes impossible. Get the people aspect right, it's still hard, but it's manageable, much more enjoyable, and you're much more likely to hit your goals. So if you're looking to add top talent to your team in 2025 and you're open-minded to an alternative approach and you're keen to make business a little less hard, drop me a DM. I'd love to have a conversation with you to see how Rockborn could potentially help you with your human capital requirements. Right, let's get back to the podcast. So in terms of the business then, it's kind of a fee basis, 6-month break, and with clear parameters in terms of where you would invest. And you typically partner with groups or pension funds that didn't have the in-house property expertise. And so they lent on your experience to be able to deploy, manage,
drive value and then dispose of assets.
And these guys, going all the way back to the beginning of the 90s, the important piece, perhaps that's a better word, was that they would give you discretion. So here's the piece of money. You go and buy what you want.
You're the expert.
You're the expert. You go and buy what you want. We'll measure you from a performance standpoint against MSCI. Report to us regularly. Come and see us once a quarter or something. But your bag, your call. Brackets. If you screw up, we can sack you on 6 months' notice. Close brackets. And that was how those relationships began to develop in the early 90s. And the Kodak one was that discretion, and that's really been the way that it's been. So when Orchard Street had its mandate with Railpen, that was discretionary. St James's Place, discretionary. The other funds that we look after, discretionary. Clients don't want to get involved with the decisions. Implicit in making a decision or vetoing a decision is you've taken some responsibility for that decision, and you don't want to do that. You're giving it to the expert to do that. So giving discretion to your expert actually allowed the pension fund to stand back a bit.
Yep. And in terms of the asset classes you would invest in, it was retail, office, industrial predominantly, but it would change depending on the client, their allocation weighting and where the opportunity was.
Yeah, shops, offices and sheds. Noting when I first started out, retail parks didn't exist, so I've seen retail parks turn up. And in-town retail just go. I mean, it hasn't completely gone, has it? But it's just about an institutional asset class still, in-town retail, shopping centres and high street shops, but yeah, not that much. And coming up on the rails has been a sort of resi and sectors, or living perhaps is a better word, segments related to resi of one form or another. Student accommodation has been around for a long time. And then other bits and pieces like nursing homes, care homes, and then most recently, of course, albeit perhaps now it's been going on for 10 years maybe, is ordinary open market residential. Build to rent, if you like to use that acronym, although doesn't have to be brand new build to rent, could be second hand. But the institutional capital into the residential market, which it hasn't been.
Yeah.
Hadn't been since the 40s, 50s and 60s. And then the regulated tenancy thing just completely mullered returns for institutional owners, and they all got out. Pretty much they all got out. Left it to some undesirable landlords. And then the government in 1987, I think it was, wasn't it? The Housing Act of 87, 88 allowed that assured short-hold tenancy thing to crop up. And so suddenly, it wasn't that sudden. It took a while for people to get a bit comfortable that the government wasn't going to change its mind with that. But over a period, people began to realise that there's an interesting investment segment here and we're not in it. And we should be more in it. But it's taken a long while, and many investors are not in resi, but I think more are looking at it more and more. And student accommodation is depending on your point of view, it's either resi or it isn't, but there's a bed involved, so it's sort of resi. But I think a lot of people have regarded student accommodation as more like a commercial property than a residential property, but it's sort of somewhere in the middle, really. But lots of people have bought student accommodation going back 20 years probably.
Yeah.
But lots of people have not bought ordinary open market residential property for the last 20 years, but beginning to now.
So give me an overview of the business today, because you've got JVs, separate account, discretionary funds as well.
Yep.
Talked about your assets under management and what you're invested in and what you do as well.
What we do? Well, look, we spotted an opportunity. We weren't unique to do this, by the way. This was just the way the market was going, and to some extent, we were led a bit by St James's Place here about responsible investing and trying to invest in the right way, invest in the right things, manage the money in an appropriate manner, and that has moved on to the environmental debate, the net zero piece, and so on, and ultimately out of that, impact investing has emerged.
Yeah.
So we started a discussion in the beginning of pre-COVID, early 2020. About establishing an impact fund. Nobody was really doing one then, so it was a bit different. We had to figure out what impact investing meant, which we got our arms around, and we went out to market with that in COVID. So the back end of 20, sometime in the summer or the back end of 21, took us sort of 15, 18 months to figure out what our fund proposition was going to be. We went to spend a few months testing it on various investors to see, is this a daft idea? And people said no. So then we came up to investors properly with a proper plan and a prospectus, and so here's our plan. And we were fortunate that one of the consultants latched onto it quite quickly, and said it's a really good idea. We want to do that. We've got a client that's up for doing that. And so we were fortunate to get cornerstoned for our fund launch with one of the local government pension scheme pools, the Brunel pool, and they helped us launch that program in October 22. So we carried on marketing that and have done for a few months. We then, as the local government pension scheme piece has been evolving completely separate to us, but evolving on its own journey of consolidation down into these pools and how they're all going to work. So we were fortunate to land the Brunel one, got an allocation off the Brunel one into our program to get it up and running. Not long after that, so a year or so ago now, just over a year ago from now, the Access pool looked up and we're looking for a manager in the decarb space. So we got into that pitch and that beauty parade and all that sort of stuff, and were able to win that mandate, which we were told about last September, and we closed that fund with Access in, when did we do that? May just gone. Different fund structure. Our first impact fund was closed end, finite life, 7 years. The fund for Access is open ended, and I think they're expecting to allocate to it over the longer term, or medium term certainly. Who knows about the long term?
So you've been able to kind of position or evolve the business in line with demands from your LPs or investors, or maybe the more sophistication of pension schemes and plans. And one of the things you touched on, Railpen, is maybe some of these big capital allocators bringing more expertise in house.
Yes.
And have you noticed that has had a material impact in terms of raising capital and having a USP or an angle or a point of difference?
I think the material impact for us, yes, because that's exactly what Railpen did. They built an internal team. By the way, not just real estate. They wanted to do it across all asset classes. Well, they got to real estate in the end, and they built a team, and they, in the end, come to the end of 17, I think it was. They said, we're going to take this in-house now. Thanks for all your efforts. They said, we can do this. We can do this better and cheaper in-house. So we said, okay, good luck. And I'm sure that's gone well. I've got no idea whether it's gone badly or not, but I'm sure it's gone well. So we lost that mandate then. SJP still growing like Billio. But then SJP, with all of the outflows and stuff, in the end took the decision to shut down. So they did that last November. Standard 6 months notice. So we got our 6 months, and we exited that in the end of May. But make your own luck. Perhaps that's what you do. You make your own luck. So we'd made our own luck by pivoting towards the impact segment or the impact strategies, which we started doing early 20, done a fund, we then won another one from Access. SJP decides, by which time, by the way, SJP that had been 3 billion for us at one point was down to 1 billion. Wow. And we'd managed 3 down to 1, which, by the way, is a really terrible way to motivate people when you can just watch your assets going out the door.
Quite, just, and your fees linked to your AUM, and
all of that stuff. Just terrible. So at one level, they decided that they'd rather the final little piece should be managed by somebody else, and I understood why they came to that view. But by then, make your own luck. We'd won Access, we'd launched our first impact fund, and so we've pivoted the business away from running, not completely away, but away from running core balanced mandates towards running strategies more aimed at decarbonisation, or if not full impact, and therefore not core balanced mandates, not trying to achieve a core return, but trying to achieve core plus value add type returns, maybe with leverage, maybe with promotes. It's a different type of arrangements, different fund objectives, still investing in real estate, mind, but trying to do other things with real estate, trying to buy an asset and materially improve it from a decarb perspective, and dare I say even an impact perspective. Trying to deliver pure proper impact is quite hard.
Yeah.
We know what we're doing, and we know it's quite hard, but you can do it. You can do it, and there are opportunities to do that in all segments of the market. Office is probably the most difficult because occupier demand in offices is perhaps the most challenging at the minute, unless you build the most super duper
best in class
net zero, etc., then you're in with a chance. But if you're not quite that,
it can be quite difficult. How hard has Trump made impact investing? Because this is pre-Trump, right? In terms of being able to raise the money, allocate to it, the story.
This is pre-Trump 2.
Pre-Trump 2, correct.
Trump 1 was around.
Yeah,
then.
Sure. But pre-Trump 2 with the, kind of drill, baby drill, and the rollbacks around.
The gossip would have you believe that Trump had said to pension fund trustees in the States that if you allocate to anything to do with impact or net zero or decarb or anything, you must be giving up returns, so you're going to get sued. I'm not saying I ever saw that written down, but that's what I sort of thought I heard from various people. Whether that's actually what happened, I don't know. But I think investors have stepped back a little bit, maybe more in the US than over here. I think over here, certainly on the local government side, I think there's still plenty of ambition to invest in a smarter way from a decarb perspective, and a maybe not full impact, but certainly heading towards impact in some respect. Trying to get your buildings to perform better. Can you make the building better for those who are going to be in it and live in it perhaps, or work in it? Can you just make it better, healthier, that sort of stuff? Can you do something for the community that wasn't otherwise there? Can you do all of those things? Yes, you can. You need to do all those things to bring some additionality to the proposition, because otherwise you're failing, really. You're just another investor, aren't you? But you got to think through all of those things, and impact. There's been the industry, the wider industry has grabbed hold of the impact word and made certain that if you're going to use the word impact, it's got to mean something. You can't just greenwash something else and say that's now impact, because that doesn't work. So you've got to work quite hard with measurement structures, scoring systems, setting targets, all this sort of stuff. So if you go and buy a building and say, well, I'm going to improve the air quality, okay, brilliant. Well, how much? Oh, that's a good question. Well, I'm going to take it from, I don't know, whatever the measurement is. I'm going to go from 100 to 200. Okay, all right, fine. Go on then. And we'll have that assessed at the beginning. Independent people, making certain people don't mark our homework for us. So independent people will tell us, yes, it's 100 at the beginning. We get that. We know you want to go to 200 at the end. We get that. And we agree with you that that's, and the key words are material and ambitious. We agree with you that that's ambitious, material and ambitious. And we agree with you that you've set up a scoring system to measure not only the 100 at the beginning, but the 200 at the other end. We agree with you that that's a valid scoring system. Off you go and do that. And then when we get to the other end, we got another third party that will come in and measure it. So with our impact fund, part of our promote is at risk to not achieving our impact objectives. So it's partly financial, but partly, did you do what you said you would from an impact perspective?
Talk to me about the market at the moment.
The market at the moment, yeah. It's changed a bit, hasn't it? So a long time ago, when I was a bit younger, it was, long leases, upward only rent review clauses.
Well, that's turned off now, hasn't it?
Tenants
as of this week, government intervened, L&T 54 Act, no upward only rent reviews.
Tenants that didn't go bust in those days, just the tenant's the tenant. Okay, fine, marvellous. And now, we don't have 25-year leases anymore. I mean, every now and again, I think you might see one in the care home business area, maybe. Somebody does a sale and lease back on something, and that might be a 25-year lease. You don't really have upward only rent review clauses anymore, because leases are not often longer than even 5 years. Maybe sometimes with office buildings in London, you might get 10. But pretty rarely 15. Sometimes a retailer on a retail park might give you a 15-year lease. An Aldi or a Lidl might give you a 15-year lease, might do. But 10-year leases are unusual unless you're perhaps offices in London. So, but most leases that we've been doing we do lots of multi-let industrial and have done for a long time. They're 5-year leases. So
a 3-year break or
with a bit of luck, no. But 5-year lease with a bit of luck, not inside the act. Rent review clause irrelevant then. So it's all about just managing your income, trying to keep yourself full, being in charge of your own property, which is sort of a reference to the 54 Act thing from with your lease being protected. It's our property. If we understand that tenants might want to stay in there, and if people do want to stay in there, then that's fine. Stay in the building, but don't have an advantage through the legislation to be able to stay in the building. So we try and, certainly with the industrial space, we try and have leases that are not protected by the 54 Act. They tend to be 5-year leases. The rent review clause is irrelevant, therefore. And we just try and manage the socks off that stuff, keep it full, keep the rent ticking along. Really nice multi-let properties has tended to be the Orchard Street way because there's more opportunity to intervene with your asset and improve it because you've got more lease events.
Yep.
And with shorter leases, you've got more lease events. And so you roll that forward into an impact kind of agenda. You've got more opportunities to get into your building and solar panels, heat pumps, insulation, all that sort of gubbins. You can refurbish the property from a not only just from where the market would like, but from a net zero perspective too. And depending on exactly what it is and where it is, if you get the refurbishment right from a ESG perspective, you'll get more rent and you'll let it quicker. And even if you don't get more rent, you'll let it quicker. So one way or another, your downtime is less.
Yeah.
And you're going to spend a little bit more on it, maybe not a lot more, but a little bit more to get it to that quality. But then it should depreciate more slowly. So you're getting benefits, and I think that's, to some extent, I think some of the investors may have stepped back a little bit from that wider agenda because of Trump, may have done. But if you want to go down the sort of impact decarb kind of perspective, which a lot of the local government guys want to do, then not so much. But from the market perspective, we still like the industrial market. We still like the retail park market. Don't much like offices and central London offices, which is perhaps where the demand is strongest for super duper brand new ESG strong buildings. Is not our bag. We haven't got the firepower for doing that sort of stuff. That's not really what we do. But multi-let assets in principally those two asset classes of industrial and multi-let industrial and retail housing, which is kind of the same building, isn't it? One's got glass on the front, the other's got crinkly tin, but it's kind of the same building. We quite like those segments. And then we're increasingly looking at the living segments. So sometimes student accommodation, sometimes just ordinary residential. We're looking to try and get more into that space. I think there's good opportunities there. The senior living end of the market, I quite like that. Looking for entry points into that. Not easy, but looking for entry points there. So I think there's lots to go at, but the market has changed. It's not shops, offices and sheds now, is it? It's not really shops. It's not really offices. It's industrial or retail parks, which is, and it's living. And it's shorter leases, rent review clauses, who cares? And it's a much more active asset management approach that I think most people who look after real estate are practicing that approach.
And really, really earn their management fees,
Yeah.
which are getting compressed anyway.
Indeed, yeah.
Just with more...
The Australian influence is arriving over here. Thanks, guys. Exporting your low fees, brilliant.
I'm going to butcher this stat, but it's something like 80% of 5-year debt's maturing in 26.
Yeah.
And it's going to move from a 2 to a 4 or whatever it might do.
Yeah.
Does that give the disciplined, patient investor an ability to kind of pick off really good quality kit at a discount because current managers just can't afford the refi costs?
Yeah, maybe. I think where that manifests itself most is in the resi market, which at the moment has sort of ground to a halt. I think agents would tell you there's some turnover going on, but it's pretty difficult with owner occupiers of residential, as you say, were on 1.5% to 2% mortgage rates, and now they're going to be on a 4+. I don't know what happens there, which is probably why I think there was a statistic the other day of house prices went down in the last month or the last quarter, except over the last 12 months they still went up. So which one do you want to look at? But I suspect house prices are not going anywhere really at the moment, are they? So I think residential is quite an interesting opportunity, because whilst the owner-occupier market might be struggling a little bit, the rented market, I mean, private landlords being encouraged out by the government, therefore the stock of rented property is dwindling because private landlords are going. The pace with which the institutional market can build to rent is not at the same pace.
Yeah. And
So-
a lot of people are saying it just doesn't even stack right now with build cost inflation. And
Yeah, so I don't quite know how the government squares that circle.
yeah, with Gateway 2 and Gateway 3 and
Yeah,
all those parts.
yeah. So I think the residential market from a rented perspective is quite interesting. I think the commercial market, we look at lots of office buildings because, maybe we've missed a trick here. Maybe there is an opportunity in the office space. We haven't made one work for us lately, particularly because most of the capital that we're active with has an impact type of objective to it as well. So we're probably not going to scrimp and save too much on our capex budget. We want to deliver a nice property. And by the way, we only want to buy second-hand properties because that other lovely stat, 80% of the buildings that are going to exist in 2050 are here now. So somebody else can worry about the 20%, building those. We're focused on the 80%, buying second-hand, trying to improve them. And we sort of talk about trying to buy buildings with good bones. Buildings that are purpose-built, fit for purpose, are going to last. And then it's worth your while spending a bit of money on it to try and get it from, take the gas boilers out, that's sort of trying to get it from where it is currently to a better place from a net zero perspective. We're increasingly thinking about how CREM's going to work on that net zero journey back down to 2040, 2050, trying to avoid assets that are going to be completely stranded. All this sort of stuff is all new, isn't it? The last 5-6 years, maybe. So I go back to when I started. What are you talking about? Stranded assets? What does that mean 40 years ago? Well, life's moved on, doesn't it? But it's a different market now. Completely different market.
What are you most excited about? Obviously, lots of challenges, some difficulties. As you touched on, 40 years in the industry, seen a fair few ups, downs, recessions, setbacks. But at the time, it can be quite challenging to see a way out. But inevitably, there is, and there's always opportunity. What are you most excited about if you cast your eye forward?
Well, look, I think we've found a little niche with the local government market, which I'm kind of tickled pink with. That Orchard Street's got as one been awarded, allocated, whatever the right word is, capital from local government for a couple of different strategies. That's nice. I'm hoping we can build on that. I am excited about what we can do on the resi side. I think there's completely green grass there for Orchard Street in terms of Orchard Street's never been anywhere near residential. So we haven't got any legacy stuff going on in Orchard Street we need to worry about. It's completely unfettered turf for us to play in. So I'm excited about what we might be able to do in that space. And I think there's an opportunity there too. I think particularly with some form of decarbed agenda to it too, delivering better homes for families, more homes, better homes, buildings, homes that are going to last. That sort of thinking. I think there's a demand for that in the market, and especially if you've got the right credentials as a landlord. I think you've got to have the right approach to managing residential tenants, and there are some in the market who definitely do that. But it's definitely a space in the market, as we all know, where landlords, perhaps going back a few years now, perhaps a couple of decades, have been really unscrupulous, and so you don't want to do that stuff, do you? But the press can leap on you really quickly if you go anywhere near that stuff, even by accident. So you've got to have the right standards, high standards, and try and maintain your portfolio and your tenant portfolio in the right way. Try and do the right thing for your tenants. Try and keep your tenants wanting to stay in your property. And there are groups out there who are definitely achieving that. So there's a place for a good quality institutional caliber fund manager in the resi market. There are some operating already, so wouldn't be alone. And if we can do that with a little bit of a net zero piece to it as well, I'm not saying you can get. Same point about second-hand. We don't want to build brand new, but it's quite hard to get second-hand properties all the way to net zero. But if we can buy, D and E EPCs and improve those to Bs and Cs, I mean, I think it's 60% of the market. It can't be let after 2030 because from an EPC perspective.
Yeah, staggering.
That's a bit like my 80% of the buildings in 2050 exist now. Well, there's so much of the resi market where the EPCs are terrible. And how are they going to get improved? Well, we can improve them because apart from anything else, we know what we're doing. And I'm sure, I'm not saying Orchard Street's unique here because I'm sure we're not, but we do know what we're doing. Improving buildings from a net zero perspective, improving EPCs, thinking about how you can put the CREM agenda on top of that too, and so on and so forth. So that's exciting. That is exciting. And I think the market as a whole, it continues to change. Never stop learning is a key point. Every day when you finish, try and make certain you've learned something and take that on. And so, I'm excited about the future. I think there's lots to get done. I think Orchard Street's in a really nice place. We've reinvented Orchard Street now away from core balance towards a place that I think there's plenty of growth and plenty of opportunity. So it'd be nice to see where Orchard Street gets to in the next 2 or 3 years.
Philip, so you've had a 40-year fund management career. For someone listening to this who wants to get into the fund management game, what advice would you give them?
Yeah. Well, you got to do something you want to be passionate. You want to be passionate about what you want to go and do, because you're going to get up in the morning, spend a lot of hours every day doing it. So you might as well enjoy it. And then if you're going to enjoy it, you're probably going to be passionate about it. And those two things, I think, come through when you're doing stuff. But I think in our world, as it relates to real estate, fund management more widely, don't know, probably still applies. From our world, we have we're blessed with being given a fiduciary responsibility by our class to look after their money, and that's a big responsibility. But it's a number on a piece of paper, so you've got to know how to do numbers. And the youngsters who come into our business, and not just our business, but many businesses these days, analysts who come into the business. I mean, some of these guys today, guys and girls, are so clever with how they can manipulate numbers. So having an understanding of how numbers works is incredibly important, I think. And if that isn't, let's put it the other way around. To come into our world, I think you need to be comfortable dealing with numbers. I think that's important. That's important for our business, definitely, and has been for a long, long time. And I'm sure it'll be even more so going forwards.
As we draw to a close, the question I ask everyone on the podcast is, if I give you £500 million worth of capital, who are the people, what property, in which place would you look to allocate that
What return do you want?
It's a very good question. Let's do value add returns.
Value add returns.
Yeah, let's go value add returns with my 500 million.
And when do you want your money back?
Let's do 5-7 year close-ended fund.
Okay. 500 million means you're not going to put it all in one building, are you? So you're going to spread that around a few things, which means you've probably got 20 and up, and the upside 50 million, 20 to 50 million per property-ish. I quite like the fact that 80% of the total return from real estate has come from income over the long run. And now unleveraged, okay, but still, nonetheless, the income piece is a big part of your return. And you can go and buy a building and, in extremis, knock it down, rebuild it, but get no income along that journey and just hope for a decent pop at the other end. Or you can try and look to the income to provide you at least some of your return. So income focused, I would be, which allows you then, the leverage piece is a little bit more straightforward. So I'd have a little bit, if you want a value add return, you probably need a little bit of leverage, but you don't have to shoot the lights out with that, but 30 or 40%, maybe 50. And then I buy the sorts of things that we buy. I mean, we love the multi-let industrial market. By the way, we're not alone. So you've got to work quite hard to find opportunities that you like. Quite like the retail park market. Again, we're not alone. Probably don't much like the office market, as we've touched on through this discussion. London offices are that's one thing, but they're 500 million might buy you half of a big one out here, so that's not going to be where we're going to be, and we're not going to go and buy offices in. You might persuade yourself to do one in Manchester or maybe Birmingham or something, but you're not going to buy one in smaller towns anymore, like we used to a long time ago. I don't think you're going to go buy shopping centres. You might, with the odd one here and there, be very much deal-led, but from a top-down perspective, I don't think you're really going to go and buy shopping centres. So I'm retail parks, I'm multi-let industrial on some proportion or another, and I'm going to find something to do on the living side, which might be more student accommodation to get the kind of returns that you're after, because I think you can get into industrial, retail parks and student accommodation and introduce some refurbishment to it, some capex, which will get you some nice ERV upwards movement. You can buy into those segments at somewhere between 5 and 7, probably. 5 and 7, some ERV growth because of the capex, maybe a little bit of yield compression if our chancellor doesn't completely screw up the yield market in this country, a little bit of leverage. I think those things combined might get you to your value add return.
Philip, fascinating career. Thank you so much for joining me on the podcast today to share some of the lessons, views and journey. And I'm excited to see what you and the team at Orchard Street go on to do.
Thank you. Good fun. Thanks. Right.
Hey, quick one from me. If you enjoyed this conversation, do me a favour and share it with a friend or colleague that you think would get value from this conversation. It would mean the world and help grow the People Property Place podcast. Thank you so much.